friends, and welcome to another
Namaskar.
episode on this channel. We are actually going ahead with the our discussions on money matters and Samriddhi Sopan. We are trying to explore a very important topic on this. As if you have followed the previous episodes, must have come across that we try to give you an initial idea about financial planning. But today we would be exploring the very important topic, which is called the life cycle of an investor. So, no matter where you are in your financial journey, this discussion will definitely help you to understand how your investment decisions should evolve with time. So, just to guide us through this, we have a very special guest, Dr. Ravi Bhattacharya, academic researcher and someone who has been deeply involved in financial literacy initiatives. So, on behalf of TCC, I heartily welcome you, Avigda, on this channel again. And as you are aware, that today our discussion would be more to do with the life cycle of an investor. So, welcome, sir. And if you could just start off with this ideation, like what is the investor life cycle?
Uh, Thank you, Shudipto. Thanks for introducing me. Please note that I'm not a SEBI registered financial advisor. It is just a awareness purpose. I have seen many educated people still required to understand the basics of the financials and the personal finance. For this reason, we have taken these initiatives. And let's come back to your questions. That is basically the life cycle of the investors. You know, the life cycle of the investors refers the how a person's goals, risk appetite, financial responsibility, investment strategy evolve around his or her total life. So we can typically divide into the four part. One is early career, that is the uh, foundation stage or accumulation stage. Thereafter mid career, which we are at present, that is accumulation stage. Then pre-retirement stage. Then retirement and the distribution stage. These are the four stages. We can broadly classify our life cycles of the investors, and we according to plan our investment. Of course there are many exceptions. They are basically uh, they are basically the very talented people, but general people like us, we require to follow some kind of financial discipline. And here life cycle of the investment plays a very important role for our personal goal and financial planning, which I have already mentioned.
So, if we are dividing this into four sort of category, It is just like, our whole life is divided into four parts. Similarly, this also is divided into four sort of stages.
Right.
So, let me say, like, if you're talking about, let's talk about the early career stage. I believe you are talking of the stage
Huh.
when we are in the mid of
Right.
20s or early 30s. So, what should be that person who are there, what should be their focus on?
Let me add, we require to, as I told you, that accumulate. This is the early career stage start uh, 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 under 30. It can continue till 40 or 45. Thereafter, after 40 or 45, the mid career starts, then followed by the pre retirement stage and the retirement stage. Okay, so and depending on if someone has taken the VRS, so his retirement stage will come early. If someone will retire at 65 like me, so his retirement stage will come little late. So that is something that require for this season personal maneuvering is required, and that is also required to be understood. And based on your questions, that as I told you that someone in their early 30s or how what should be the focus on basically. So first of all, I talked about that once a person start earning in our previous podcast that emergency fund is one of the basic requirement. So he will start building the emergency fund. Once it is built, then starting SEEP and the investing continuously as a making investment as a habit, they or he or she required to grow. Then at that point, he or she may take little bit of calculated risk. That will be depending on the his or her risk potential and risk appetite both. So I recommend we may do a broadcast on that also, risk appetite and the risk potential. So that how we will analyze someone's risk appetite and the risk potential. So that has to be matched. So based on that, he or she will take the calculated risk and avoid taking unnecessary loans in the early stage of the career, like car loan and etc. It is either you accumulate the money thereafter, you take any chase of your dreams. Then early discipline sets the essentially what I want to say in a nutshell that this early discipline set the foundation of the long-term wealth building. So that is we have to keep in mind.
Okay. So, majorly, when you're taking the first step of your financial planning, what I understand, this is the early stage. So, focus is more on to learn the basic threads of the trade, how to go about it, and not to take it's sort of a risk averse position that being suggested, keeping an emergency fund, etc., etc., and avoiding unnecessary loans. So maybe this could be the first stage of getting disciplined in matters of financial planning. So next, yeah. So next comes your, let's say, the second stage, which is the mid career, in which or the accumulation stage that you're talking of. So maybe in that stage, there will be a lot of addition, sort of liabilities, so to say, like, in terms of responsibilities being expanded. You
You've
are
already taken a home loan.
right,
You have a family, and for maybe you require to bear the your education of the kid. These are the essential, and you have got an aging parent. They he or she required to take care. So you got a huge responsibility on your shoulder.
right,
Most of the cases.
right.
So that is something that we require to take care of it. And for this reason, we require to actually safeguard yourself, and thus you require to buy adequate insurance first time, because it depends on uh, your liability. So if you have a liability, like if you are earning of your family, you got a wife, you got a kids, you got an aging parent, so you should be adequately covered by the insurance. I rather prefer the term insurance. That can be a separate discussions on that. So then, and thereafter, whatever money you are left out, you should be well diversify that money across the equity, debt, fixed income, and gold. So these are the few things that you require to keep in mind. Then plan for the major goals, because there you not only take the responsibility, you require to make your life enjoyable. You may you may go for the foreign trip with your family, etc., etc. And for this reason, you try to plan, or you may like to shift out in a value segment, like want to have a bigger car, you may require to go for the bigger home. So accordingly, you try to build up the wealth in that period, and review and rebalance the portfolio regularly. That is one of the requirement. Every 6 months, if you have, you should check with the benchmark. If you have a large cap mutual fund, it is you just check it with the Nifty 50 and other benchmarks, so whether you are getting your investments are in the right direction or not. So that is one of the main important aspect that we require to do regularly and make it as a habit. And also, I hope that your early part you have make it a habit of systematic investment, so that still it will continue in the stage of life, and thus you require to buy adequate insurance first.
Okay, so it is more to do with the change in the outlook. So
Right.
whatever outlook that you have changed, the perspective of life changes with this sort of stage in which you are into, and based on that, you are revisiting your portfolio. So I believe, if you can just a bit elaborate on this, why are we terming this as an accumulation stage?
Right. So uh, uh, it is expected that you were your salary almost, because your salary rise is also a sigmoid curve. Initial stages salary doesn't rise more, and then once you are mid career, you have explored your potential. You may start with the BTech. Thereafter, you have done an MBA. Then you got a flip in your career, etc. So you got a ultimately you have used your potential at maximum, so that you are at the acme of your professionals, or if you're entrepreneurs, you are acme to your professional, because there you yeah. And for this reasons, we require to uh, uh, we supposed to earn the maximum money at this stage of life. One may differ. Definitely, there is a pre-retirement stage. Of course, like people like me, those who are those who are actually can get a regular increment every year. That's a different aspects. But for the many people like IT industry, they are finding difficult after 50 maybe to actually give a career flip with respect to inflation, mind it. So, with respect to inflation, your earning generally is maximum in this accumulation phase. Thus, you will accumulate maximum amount of wealth in this tenure, and thus your systematic investment and investment discipline is one of the prerequisite for your future survival as well as your make your life more meaningful.
Right, right. So, so it is more to do with, at this stage that we are talking of, this pre, accumulation stage. It is more to do with the portfolio management, to look into how much you can actually think of accumulating your wealth, so to say, accumulating your wealth so that you have a, I believe, a better retired life. So that is what the goal is up to. So then comes, what,
Later life, sir, but also the present life, because
yes.
I may have a better return life. So at that time, I may not visit Europe uh, or my cherished destinations.
Hmm.
Okay, so that has to be balanced. So you should have a money for also, let's say, your dreams, that because travel broadens the mind, travel gives an enjoyment of life. So that these are the memories has been created. So if you spend whole money on the retirement planning, definitely your present days enjoyments are wasted.
Yes, obviously. I mean, what I'm saying is it is to do with, your present, whatever is that is taken care of, but your focus is actually to
Right.
have a, maybe a better, a good way of life, a secure, life. After.
It is called accumulation phase of life. Mostly, we say that at the time of your retirement, when your active income start have got a pause, you require to have 350 months income in your hand. So you will accumulate that money in this tenure only. So for
Right.
this reason, it is accumulation phase.
Okay.
For
350.
example, let's just give a because it's a little math for understanding. If someone is returning today, having a monthly expenditure of the uh, 50,000, he or she require 1 lakh, 1 crore 75 lakhs. This money he or she should have to live.
That should be the accumulation done.
And that money required to accumulate, and he or she will accumulate maximum amount of this money in this phase
Hmm.
only. For this, it
Right.
is accumulation phase.
Right. So now, what should be the, sort of a, this pre-retirement stage that we are talking of?
Right. After 50, we generally say pre-retirement stage. Again, for the people who is retiring 65, 68, 70, you can differ. You can
Mhm.
continue you can prolong your accumulation phase little more. Uh, Having said that, generally 50 to 60 is called the uh, pre-retirement years, and uh, there you require to cut exposure to the high risk product. Uh, Rule of thumb is that you add 25 with your age. So let's say you are 50, someone is 50 plus 25, so it is 75. Only 25% of your wealth can be invested into the equity or
Okay.
the high risk segments.
Mhm.
So shift into the stable income generating investments. It can be a passive income like rental, something,
Mhm.
uh, and try to clear major liabilities. That is also important. We will have the, let's say, have a home loan, car loan, etc. I generally don't prefer car loan. That's different issue, but it is a matter of dream. So if you have a car, especially car loan and
Mhm.
home loan also, you try to close, and personal loan you try to finish it as soon as possible. So that is something that all major liabilities you will clear, and also you may have a financial, not only the loans liability but also the your liabilities from your kids, so that that accordingly you require to plan so that their educations and all those things. Even in India, we support the marriage of the kids. That also been supported in this tenure. So and create a retirement withdrawal plan, so that you will think about that I may get early retirement. If happen, what happened if I retire 5 years ago? That's the my actual rate of retirement. So that is something that we also require to be planned. So create a retirement withdrawal plan, and definitely a big mistake is delaying those adjustment until it is too late. So that is also we require to keep in mind. So
Mhm.
that is the requirement of the pre-retirement age stage.
Right. So, I mean, this is the stage in which we need to maybe it's a stage in which we need to clear our life's balance sheet. So there is no debt components. We have already created the assets that are required, and there is no sort of liability that is pending towards us because we will be soon foregoing our so-called income stream. So if there is foregoing of income stream, you have to obviously be very cautious to avoid any sort of attached liability, which is a recurring expense that happens. So that's very clear, sir. Then what's happened in the what is your views on this distribution stage or the retirement stage after this?
Yeah, like as I told you that you just check it out. If you are getting pensions or from the or any source of money, fine. Please understand that you have to follow the basic rule. First of all, whatever you are spending today to maintain the same lifestyle, we require to have a 350 months of income in your offer, and you will go for a 4% withdrawal. So you with 8% increase or the increase as per the inflation rate. Okay, so with 4% inflation rule, so that is something that if someone is having 1 crore, he or she can withdraw, that is 40 lakhs, 4 lakhs, sorry, my apologies, 4 lakhs per year. And in that case, you just see that there you may take a help of a little bit of uh, 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 mutual funds with the exposure of the equity, and maybe 20% you get from your fixed income, 50% or 30%, whatever you decide, and part of the money should come from the systematic withdrawal plan. So you can do the SWP, and that money you can keep it in the balance part. That can be a separate discussion. What type of mutual fund is most suitable for what span of life? So
Mhm.
there you can choose an uh, suitable option for the uh, SWP, and then some portion of the equity you required to keep it, because equity only can beat the inflation. So you require to keep some portion of that money into the equity, as I told you that, and you can do the SDP, or you can take the or you may take that money after 5 years if you have that kind of planning. It is also important,
Mhm.
and avoid any impulsive decision during the market volatility. Don't get trapped into the market volatility. Market has dropped, so let us get into it. So you may not get a time to again recover, and monitoring expenses carefully. So because a lot of expenses will go out in your hand, but you don't have a scope to earn more. Your income source of income is literally limited. So for this reasons, you require to also monitor the expenses, and emotional stability become the more important at this stage, because it is a shock to us that those who are in a fixed income group, they are getting salary, and just they're not getting salary from that day. So that's something you require to adjust yourself, your expenditures and other, so that you can live long with a healthy, meaningful life.
So more to do with the aspect like is the behavioral thing that is coming into play.
Right,
We need to do with the behavioral changes, in terms of like, as we all know that in a regular sort of a pattern where you are going to office and suddenly at the retirement stage you stop doing that. So obviously we have seen our parents, we have seen other seniors also. There is a withdrawal symptom that happens, and it is not about financial insecurity. It is more to do with the behavioral thing, like the status quo being disturbed. So in a way, it has to be more focused on the behavioral aspect. That means you need to accept the fact that you are in this stage and you have to follow this life. So if you just can throw something on this behavioral aspect across stages that we have discussed, maybe that would be
right,
more
right,
sort of
right.
emotional
First of
to us.
all, financial planning is just not a numbers. It is emotional. We own a car, we own a house. It is an emotional attachment to us. So emotions play a big role here. Huh? So young investors actually hesitate to begin investment. That is one of the emotional barricade I have seen for the many young people. So fear of starting. Should I invest in the equity? Yes, it is a time you should invest in equity. So that is something that same person become overconfident in the mid age, and he or she overexpose himself mainly the men I have seen more confident about many aspect. They overstep it, the risk. So that is something also the just reverse I have seen happened with in a mid career age. And retirement is often struggle with the fear of running out the money, because how much we will spend now, how much we will accumulate. So that totally we require to balance. So that is also an emotional challenge. And uh, then uh, being aware of this actually emotional pattern that you should understand uh, rightly, and you invest in a right manner. That is also very important.
Right, sir. So it has been a sort of just understanding the stages, and obviously we this thing that we have underlined or underscored the fact that investment does not are not only numbers; they are more to do with emotions that we realize later. Maybe at the initial stages when we are starting off our career, we do not understand the sort of importance of that. For us at that point of time, it is just a number that we are accumulating, but because we are unable to see something beyond the horizon that we are looking. So maybe once you are in the accumulation stage, when you see a bigger stage which is coming to you, you might be more into that mode. So that emotions of investment or emotions of savings, that is what will try to bind you in the later stages of retirement, when you lose out, or I won't say you are losing out, you have you stop having this regular income that you have to have as a salaried person. So as this discussion that we are having, it is more to do with people who are engaged in a profession in which it is to do with the salary income stages. But obviously there would be professions in which people who are into businesses, maybe people who are into other roles which actually shifts your accumulation stage in the later part of life. And there would be,
Professionals like lawyers,
yeah,
lawyers,
doctors
there
even.
yes, yes, definitely, as I told you.
Right. And there would be certain stages in which this is preponed because of the burning out that is happening right now in professional world. The IT that we see, our friends
Right.
everywhere, they are actually being burned out of the professional realm. So they are seeking certain solace. They are taking sabbaticals. They are trying to energize themselves. So in a way, everything is dependent on a person's perspective, and it is something to do with your understanding, I mean personal understanding. So this what we have discussed, it would be just a generic sort of a discussion, but obviously it should not be taken as a part like this is applicable to whosoever is listening to this podcast, or whosoever it is because your perspective, your horizons may be different. So this is what I think, uh, typical understanding that we can draw from this. So, and
If
thank you
we
so
have a
much.
segmented class, we require to discuss separately.
Correct,
For
correct,
example, IT professional or the people is opting for the VRS, how he will start their financial planning, and someone may have missed the bus. It
correct,
is not that financial planning. If I miss the, let's say, the early career,
right,
we do that? Yes, you definitely you can do that.
right,
So, and for this reason, you require a little bit of tweaking of your investment pattern and all those things. So, so you require to, but basics rules so has to be the same, So that is something that you require to see that how you manages your expenses and the
right,
earning balance.
right, right. So, thank you so much, sir. Thank you so much for sharing such clear and actionable insights. I do believe that our listeners have been benefited, and they would be able to understand the perspective of our discussion and find this extremely valuable. So, and to our audiences, please put in your questions if you have any. If you have any suggestions on this, if you have anything to share regarding your financial planning, or you want to be in discussion on this subject, please, you are all welcome to.
Your request, yes, I got some questions. We got
Mm,
some question, I think, but we if we find sufficient amount of question, we may
right,
actually do an Q&A on those questions
definitely,
on a podcast so that your answers also, your question has been answered best of
right,
our.
right. So, I mean, to all our listeners, obviously, it would be right for you to pick up the threads and understand this perspective discussion. If you have anything to share with us, as Dr. Ravi Bhattacharya has stated, please send in your comments, your suggestions, your queries, which are there given in our either in the comments section, or you can shoot us an email and send us on the WhatsApp. Also, every other details are being shared while this podcast is being run on your screen, so you can note those numbers and you can share with us. And also we would request you to kindly like this video, this podcast, so that we are also feeling encouraged to do certain aspects and go more depth into it. And please remember, whenever you're doing a financial planning, please put your all perspectives, your life goal into it, so that any assumption that is missed out while you are doing a plan, your something will be missed out in your final goal. So please make sure your planning is as smooth as possible, as practical as possible, so that you make the most of it. So thank you, sir. Thank you
Thank you.
once more, and let's meet up again in a very short time. Thank you
Same
for
to
your
you.
time. Thank you.
Okay.